So there's this company called Strategy, and they have access to infinite Bitcoin. Not really, but it's close. Until 2020, Strategy was a completely forgettable business software company. Enterprise analytics, the kind of thing you nod politely at before changing the subject. And then their CEO, Michael Saylor, had a thought. What if instead of running a software company, we just bought Bitcoin? Not as a side investment, not as a hedge, but as the entire point of the company. Here's how it works. Strategy is publicly traded on the stock market, meaning anyone can buy a piece of it. They can buy a share. When a company needs money, one option is to create new shares and sell them to investors. This is called issuing shares. It's legal. Companies do it all the time to raise capital. So that's exactly what Strategy does. Strategy issues shares, then takes that money and buys Bitcoin, then issues more shares, buys more Bitcoin with that money. They actually executed a $21 billion common stock raise and used it to add 301,335 Bitcoin to their balance sheet. As of mid 2025, they hold 628,791 Bitcoin, the largest corporate Bitcoin treasury on Earth. At the time, Bitcoin was worth around $107,000, meaning they held $67 billion worth of Bitcoin. As of their Q2 2025 filing, it cost them around $46 billion to buy all of this, with an average purchase price of $73,000 per Bitcoin. So, really, not all that bad. They've been buying Bitcoin at low prices and they've profited almost 20 billion from it, and they've kept buying more. Every week, almost without fail, Strategy buys more Bitcoin. So it sounds like a glitch, an infinite Bitcoin glitch, like someone found a way to exploit the financial system and just kept running it. But here's where it actually gets a little complicated, because when Strategy issues new shares, existing shareholders own a smaller piece of the same pie. This is called dilution. If there are 100 shares and you own 10 of them, then you own 10% of the company. But if that company issues 100 more shares, suddenly you only own 5% of that company. Nothing about you changed. The company just printed more of itself. Strategy has inflated its shares outstanding by roughly 20% in 2025 alone, and its stock fell 70% from its all time high during the same period. So, the more they buy Bitcoin with money collected from issuing shares, the more investors own less of the company. And then there's the structural trap nobody advertised. The strategy only really works as long as Bitcoin's price keeps going up. Bitcoin appreciation raises MicroStrategy's stock price, which then allows them to sell shares at a very favorable high price, meaning you pay more to own a share of MicroStrategy, which allows them to then fund even more Bitcoin purchases because every time they dilute, they get a bigger and bigger amount of money. But if Bitcoin drops, the stock drops harder. The stock has historically fallen 64% from its peak, while Bitcoin declined only 27%. A falling stock price means that new shares they issue are actually worth less, meaning you also raise less money per share issued every time you dilute. And this means that you're able to buy less Bitcoin, which means confidence drops, which means the stock drops even more. So this turns from an infinite Bitcoin glitch to just an infinite glitch. MicroStrategy is stuck. If they stop buying Bitcoin, investors are going to ask for their money back and they won't be able to buy more Bitcoin. But if they keep buying Bitcoin by issuing more shares and diluting shareholders, then they're going to make their own stock price go lower and lower and lower, even if they do manage to buy more and more Bitcoin. And that's why things are so bad if Bitcoin actually goes down. As of July 6th, 2026, MicroStrategy currently holds 843,775 Bitcoin, more than 200,000 more Bitcoin than just last year. But because the price of Bitcoin has dropped, from around 107,000 to around 63,000 at the time that I'm recording this video. Their investment is now only worth $53 billion, despite them spending $56 billion to get all that Bitcoin. Now, the good news is that their average purchase price is at an average of around 66,000 per Bitcoin, which is less than 73,000. So, they're issuing shares to buy as much Bitcoin as they can as prices have fallen. That makes sense. They know full well Bitcoin goes in cycles and will eventually rise again, and then they'll be profitable. But still, investors get irritated when prices drop. It's hard to deal with people and their money who want a return or threaten to pull their investment. Then, MicroStrategy thought that they had figured it out. They created the preferred stock problem. To raise even more capital, Strategy has been issuing shares paying 8% to 10% annual dividends, meaning they owe investors that cash every single year, regardless of whether Bitcoin goes up or down. Now, while critics are doubtful, calling it basically a house of cards, Saylor calls it a treasury strategy. So why keep going? Because so far for strategy, it has actually worked. Bitcoin's price keeps going up, outpacing the cost of the dilution. So your shares in the company keep increasing in price, even if your percentage of strategy, the percentage that you own, keeps going down.
75% of a watermelon is a whole lot better than 100% of a grape.
Strategy's holdings at peak represented tens of billions in paper gains. So even if your ownership stake went from 10% to 5%, your Bitcoin could have gotten 5 times more valuable. So Saylor's bet is simple. Bitcoin keeps going up, the dollar keeps going down, and any amount of financial engineering in service of accumulating more Bitcoin is rational. So the approach MicroStrategy is going to take in 2026 is a binary one. They are basically hinging their entire existence on the recovery in Bitcoin's price. And if that doesn't work, disaster is the only other option. If Bitcoin wins, strategy wins bigger than almost anyone. If Bitcoin goes down, well, they'll have issued a lot of shares.